Trump's tariffs are back in the headlines, and with them, market volatility. But here's the real question. Should you be worried, or is this just another short-term bump in a long-term plan? Now, history tells us one thing, but your portfolio needs to be set up the right way to handle it. So let's break it down without the media hype so you can stay calm, diversified, and on track for your retirement. Hi, I'm Jordan Lehman, founder of True Wealth Retirement Partners, and every day I'm helping my own clients create steady retirement income, invest smarter, and pay less in taxes. And actually, guys, this video is an adaptation of one I sent to my own clients. So no, this is not some social media influencer, clickbait, fear-mongering, or hype train video. This is exactly the kind of conversation a real financial planner would have with their own real clients. So I hope you find it helpful. Now, if the current state of things feels like uncharted territory, here's a reality check. We've actually been here before. Now, back in 2018, Trump's first round of tariffs on China created similar uncertainty, and the markets at the time did see some turbulence. But know this, by the end of his presidency, both US and international markets had delivered solid returns. Now, if you don't remember this, let's take a look at a helpful resource that my friends over at Dimensional Fund Advisors put together, breaking down Trump's first term, the tariffs, and the subsequent market performance. So let's take a look here. I'll link to this resource in the description, but we want to look at Trump's first term. So this is in 2017, just after Trump was elected. And this is looking at three different markets, guys, okay? An index of the Chinese stock market, the S&P 500, so US large companies, and an index of international stocks. And all horses start with $1 at the beginning of Trump's first term. Now, we see in 2017, Trump calls for what? Tighter tariff enforcement and a review of U.S. trade deficits, and Trump and Xi meet for a 100-day plan for trade talks that end without an agreement, maybe unsurprisingly. And what have we seen over that time? Some steady market growth. But in 2018, what happens? Like we just talked about, the U.S. imposes tariffs on washing machines, solar panels, steel, aluminum products. And China doesn't just sit there and say, okay, fair enough. They swap retaliatory tariffs up to 25% across a range of products. And the US and China then agree eventually on a 90-day halt to new tariffs. This was in 2018. What did we see? Sure, some market volatility. Now, in 2019, trade talks fail to materialize. China says we're done purchasing U.S. agricultural products. And in 2020, eventually a trade agreement is signed, and yet the previously imposed tariffs remain largely in place. Now, do we see volatility over this period? Absolutely. Do we see volatility in every period? Yes. But what actually happened in markets? Well, $1 in the Chinese stock market grew to $2, a doubling. $1 in the S&P 500 grew to 181, and $1 in international markets grew to 141. Now, again, this isn't to say this is a one-for-one, and this is exactly what you should go to and expect. We know past performance doesn't correlate to future results, and it's helpful to remember this is not new. Okay, so what's the takeaway? Trying to time the market based on political headlines is, quite frankly, a losing game. Please rewind the video and listen to that one more time. Now, here's what we're seeing so far. I want to speak to 2025 year to date. U.S. stocks had modest gains through mid-February, but as we know, they've since pulled back a bit as the markets digest this latest tariff news. Now, to give you some context, here's some of the major indices performance year to date. And guys, you're going to be seeing this video probably a week later. This is as of March 5th. So let's hope markets are straight up from this recording. But so you know, this is as of market close March 5th. The S&P 500 down 0.44%. The NASDAQ, US large tech companies, down 3.78%. And the Russell 2000 values, more small and value companies, down 5.87%. Now, before we jump into some of the good news and give you some ideas on how to think about this, I want to sit here for a moment. Significant market declines happen almost every year, but that doesn't necessarily, get this, mean that the year will end in losses. I want to bring up another resource here. In fact, in 17 of the last 20 years, the US stock market experienced mid-year declines and still finished positive. So let's take a look at that. So this is another resource prepared by Dimensional Fund Advisors. It's looking at, do downturns lead to down years? We're looking at the Russell 3000. So that's an approximation of the overall US stock market. And we're looking at how far did stocks dip in the year, and what was the actual calendar year return at the end of the year. So let's bring us back to COVID in 2020. This is an extreme example. We saw the early year dip. In fact, the Russell 3000 was down 35%. And yet, the year ended with a 26% positive return. We can also look at a 2008, for example. The Russell 3000 at one point was down 49%. Diversification is important, people, and yet it ended up at minus 37%, some concession. We can also look at, say, a 2009, the following year. At one point, the Russell 3000 was down 27%, and yet it ended 28% positive. What's the takeaway? The takeaway here is that short-term slumps do not dictate long-term results. And while every year obviously does not end up positive, it's critical to know, even to expect, meaningful mid-year stock declines. And I get it, downturns can feel unsettling. And yet, history shows us that sticking to your plan and maintaining discipline over time has been rewarded. Now, here's the better news. For those of you who are properly diversified, you're already seeing the benefits. And while US stocks have dipped, international stocks have actually held stronger. And again, this is as of March 5th, 2025. Here's how they're doing. International stocks, as measured by the MSCI EAFE index, year to date up 11.67%. And this is exactly why diversification matters. It helps buffer your portfolio when certain markets take a hit. Now, as a bit of a tangent, over the last few years in analyzing many portfolios for people, I've noticed fewer and fewer investors with meaningful international stock holdings. It's almost like there's been this mass amnesia about the dead decade from 2000 to 2010, when the S&P 500, the golden boy of the last decade, last 10 years here, was flat, while international stocks saw positive returns. Now, the right mix, get this, of international stocks depends on your personal situation, your investment philosophy, but one thing is clear. Those who have maintained international diversification over these last few weeks are seeing the benefits firsthand. And by the way, if you're retired or thinking about it, I'd be happy to sit down with you and review what I call the retirement readiness of your portfolio. So there's a link in the description. You can click that to see if you qualify, and let's find a time to chat. But back to the video. We've talked about US and international stocks, but diversification, get this, doesn't stop there. And another key element, well, it's what I call your war chest, or I call it that with my clients. It's the portion of your portfolio set aside in bonds and cash. Now, get this, this isn't money just sitting on the sidelines. It's a strategic cushion designed to give you financial stability when stock markets drop. And as of March 5th, 2025, the aggregate bond index is up at 2.37%. Here's how I like to think about it with my clients. Most people will talk about an 80-20 portfolio. There's 80% stocks, 20% bonds, or maybe a 60-40 portfolio where 60% is in stocks and 40% is in bonds. But what does that really mean? I like to step back and actually translate the amount of money you have in bonds, and this is really important, into the number of years you have in retirement income. So let me explain. Let's say a client has $1 million in, say, a 75% stock, 25% bond portfolio. And let's say they're pulling about $50,000 out per year as income from the portfolio. Well, based on their, get this, 25% bond allocation on $1 million, they have $250,000 in bonds. But what if we translate that into years of retirement income? If they're pulling $50,000 a year, they have, get this, 5 years of retirement income already set aside in their war chest of cash and bonds. And knowing this number can actually help guide your overall asset allocation and create peace of mind amidst fluctuations in stock prices. Many of the major stock market crashes nearly or fully recovered after 5 years. However, someone who's even more conservative may prefer having closer to 6 to 7 years of income set aside in their war chest. Some may be more, some may be less. And by the way, your financial plan or your income plan will guide you to the amount that you would need for a year of income. But either way, when the stock market is down, you can look to pull income from cash or bonds rather than, this is critical, being forced to sell your stocks at a loss. This can both give you the income you need and your stocks the time they've needed historically to recover from market downturns. So, what should you do right now? What's the advice I'm giving my clients? If the recent political and market turbulence has you feeling uneasy, there's 3 steps I'd recommend to help keep your retirement strategy on track. Number 1, please, I know you've heard this before, turn off the news. Their job is to fan the flame of your negative and anxious emotions, to keep you watching so that what? You buy the magical supplements they sell on the commercials. They don't exist to support your retirement goals and discipline. Number 2, remember your war chest. And if you've built a solid plan, you likely have 3 to 7 years or more of income set aside in cash and bonds. Literally write down this number on a sticky note. Put it somewhere if you're wrestling with some fear or some anxiety. This means you don't have to touch your stock investments during the, get this, inevitable market downturns. And there can be a kind of swagger that you have knowing, hey, I've got the next 3 to 5 to 7 years preset from day one. And number 3, stay disciplined. Listen, market ups and downs feel different when you're retired, but reacting emotionally is what derails even smart investors. Stay the course, trust your diversification, and remember, done correctly, your plan was built for times like these. So I'll leave you with one final thought. Guys, volatility isn't fun, but it is normal. And more importantly, history has shown that patience and discipline are rewarded. Stick with your strategy, stay diversified, and let the markets do their thing over time. So if you found this helpful, hit the like button. If you want to see more insights like this, you can subscribe. I'm confident your future self will thank you.